Now we pivot to China. And there's a lot of, there's a mixed bag in terms of some of the things that have happened in general. But there's some key pieces that we want to look at as we go across the next couple of weeks. And one of the key ones, which we're going to talk about, is the Belt and Road Initiative. Now, for those that have been following me or talking to me or know me for more than just what you've seen on camera, I've been very, I don't want to say against, but I've been very critical of the Belt and Road Initiative. I've been saying on multiple occasions the weakness of it, that it actually exposes the country to more international harm and more international debt crisis than what is perceived. Because one of the biggest pushbacks that I always got was that the Chinese debt was local and they could control it. And my pushback was always, well, the assets that are backing it are external. And so even if the debt is local, you still have external exposures because the money was lent to non-Chinese entities, and the assets don't cover the principal, let alone the interest. So therefore, you have a non-China threat to the sanctity of the credit system. And I think that as that plays out, you're starting to see a bit more of a panic from China, which is why they've issued some, let's just say, reprieve to some of these assets, and it comes at a cost. And those are things that we want to highlight, and some of the underlying problems that we continue to see with China's stability. So now when we look at aggregate financing, as we said on last 2 weeks ago, that it was better than expected, but still at the fairly low end given where things are on an aggregate basis. M2, slightly better than expectations. M0, same thing. New loans came higher, but again, new loans still were below what was expected given some of this time period, which is why money supply on the M1 level was slightly below estimates. And that's going to be an interesting piece to watch as we go forward. When you look at lending rate facility came in at 2.75. And I think it's a good backdrop to look at what are some of the different pieces, because you had rates move down for large banks, small banks, but not rural banks. And I think that's going to be an important piece that we want to look at as we go through in terms of where the PBOC is trying to inject liquidity and how are they trying to also protect themselves, because they don't want things to run too hot, and they have that balancing act that they're trying to maintain because there is a lot of liquidity in the system. So industrial production was expected at 2.6, came in at 2.4. Retail sales were expected at 3.5, came in at 3.5. Property investment, fixed asset ex-rural came in at 5.5%. Residential property investment expected at negative 8.5, came in at 5.7. So again, some mixed pieces, but we're going to go through each one specifically because there's some mixed components of it, especially the retail sales, because that's year to date. And if in a reopening scenario, it would have expected to be higher based on what the market wanted, given it's in estimates here, but that's going to be an interesting one to unpack, which we're going to talk about more on our insights on Friday. Now, when you look at the FDI coming in at 6.1%, we'll talk about that in a minute. Reserve requirement at major banks came in at 10.75%, also was reduced for small banks, but not rural. And that's going to cause some other issues. But again, 11% to 10.75%, there was a little bit of a liquidity crunch, which typically happens right after, once you get past Lunar New Year. So there's a bit of an injection, and then that starts to get pulled out on a slow basis. But again, they're just managing flows with prime rates staying firm. And then when you look at industrial profits coming at negative 22.9, which is going to be something important to look at as we progress. Now, when we look at China's bilateral bailouts, which have now totaled about 2.4 billion. So you get an idea of the swap line dispersed by the PBOC and then direct balance of payment support. So the swap line has been open And this is, that life support. And one of the things that we've been talking about, again, you can see that it's not the first time they've done this, going back to 2015. But you can see that even though the economy was, globally speaking, was in okay position, you can see that it kept getting worse for a lot of these cross-border investments. And that's why when, again, cross-border, and one of the key pieces that people always push back on with me was that, the credit issue is local. But again, this says otherwise when you look at some of the openness to the different pieces. So this is a quote from the Financial Times. Revelations this week that China is ramping up its bailout lending to poor countries serve to highlight a potential debt crisis in the developing world. A new study shows China's rescue lending surged to $104 billion between 19 to the end of 21. And again, this only goes from 2019 to 2021. And we know things didn't improve in 22 or so far in 23. To participants in the BRI, the world's largest ever transnational infrastructure program. This figure, while striking, is minor compared to the overall debt levels in emerging markets. But even though it's minor, it still shows a problem. And that's why it's a bigger issue when you start to zoom out and you look at, well, they also have dollar-denominated debt. Dollar's been fairly strong, still stays right around 102.15, so essentially kind of the low end of the range. And there's a lot of problems within that. The Institute of International Finance estimates that total developing world debt rose to a record of $98 trillion at the end of 22 after governments and corporations filled their boots in recent years. They essentially filled them back up, which with so much debt weighing on the world's weakest economies, it will not take much to push several into default. Pressures are building. A stronger dollar is increasing the domestic currency valuation of external debts. Higher interest rates required to fight inflation are also raising debt service costs. And then, so again, you're seeing that, multiple issues, which is why China is going to try to support what they've already done. But at some point, and you might say it's like, well, just default on take the asset. But even their reduced and protected asset valuation and revenue generating capacity is missing even their own estimates, which again is an underlying problem. So then when you take the Chinese rescue lending represents over 40% of IMF lending in the last 3 years to 2021. And China's loans are not cheap when you look at where those rescue loans are. So treasury loans, Eurozone loans, IMF loans, reserve swap lines, you get an idea that if you're going to China, it's your last resort. So the fact that so much has been borrowed at a higher rate means that it's like, okay, well, how bad is the underlying situation, which is why we continue to see a broader problem at the emerging market level, but also at the Chinese level, because they're already in so deep that it's going to be difficult to pull out. Rising global interest rates and the strong appreciation of the dollar have raised concerns about the ability of developing countries to repay their creditors. Several sovereigns have run into distress with a lack of coordination among creditors blamed for prolonging some crisis. IMF has restructured about $3 billion 4-year lending program to Sri Lanka. China has declined to participate in multilateral debt resolution programs, even though it is a member of the IMF. Ghana, Pakistan, and other troubled debtors that owe large amounts to China are closely watching what happens with Sri Lanka. China's strictly bilateral approach has made it more difficult to coordinate the activities of all major emergency lenders, including several of the 22 countries to which China has made rescue loans, including Argentina, Belarus, Ecuador, Egypt, Laos, Mongolia, Pakistan, Suriname, Sri Lanka, Turkey, Ukraine, and Venezuela are all also recipients of IMF support. So again, there's that why we keep talking so much about emerging markets, why we keep talking about this bubble that keeps getting ignored when you look at where emerging market trading has taken place. Chinese industrial profits fallen again. And again, one of the things that we've been talking about is the pressure on industrial profits because you don't have that natural buyer. You don't have the U.S. coming into the same degree. You have a lot of that latency that is now starting to show up. Even though the country has reopened, you're not getting this big surge in activity and benefit because again, there's that a lot of that was saturated, and now you have a broader slowdown on buying, which is showing up here. Expectations of easing up of global tensions, have soured since the start of the year. How will China's geopolitical relations within Asia Pacific evolve in 2023? So every year, everybody starts out gung-ho that China's going to do great, China's going to play nice, and things are going to change. So everybody has this great view. But again, so 58% of people that were surveyed thought that the geopolitical relations were going to improve. That started in January. We're now in March, heading into April, and that went from 58% to 10% improving. And the view that it was going to deteriorate went from 10% to 37%. So you're getting an idea that there is a view that, again, China's not going to play nice. And that's where, when you look at this backdrop of China yuan denominated currency, reserve currency, it's like, I am not saying the US is the best out there. I'm not. It's, you can have your own opinions, but if you're going to want a counterpart and as a reserve currency basis, would you prefer the US or China? Those are your two options. There's another third one that we can debate, but if your two options are China and the US, which, lesser of two evils. Now, this is where I can say I'm impartial. I'm going to say it's the US, but this is the option that is being given. And again, more reason why I think that yuan denominated piece, which I also outlined in segment 1, is just that, a dream. So China's residential construction recovered strongly, but again, it's coming off of lows, and there's a certain amount of backstop. Floor space under construction, newly started, commercialized residential aggregate starts. It's bounced, but again, it's bouncing off of a very negative number. So the question is it going to go positive? You had a lot of support coming in, but that is being walked back now by the PBOC. So you had a lot of support that was forced to come in. You had to do it. This is happening. And it so much happened that the PBOC said, can you stretch it out a bit, because it's going to overheat things. And again, that's where this is with a significant amount of components. And that's where I just think that there is an underlying value that has to be looked at, and why we see a lot of these, again, this is a good start, but we think it's just at a start, and then it starts to slow down, and then we kind of bump along sideways. But when you look at the PBOC injected liquidity into the market, lowering the front end of the interbank rate curve, because there was that little bit of tightness on the liquidity side. And now they're trying to slowly reduce liquidity, but you can't do it all at once, which is why they adjust the swap lines, what they're coming in with, what they're coming out with. And those are some key pieces to watch, which is going to, again, continue. Now, when we start looking at the conservative growth target and where things are today, and that's where there's still a growth target, but as the new politicians come in, they're a bit more state central and less free market. And the problem is, and we've outlined it previously, and I think it's a big one, is sometimes with Bloomberg here, they assume that we're starting from scratch right now and just going forward. But there have been poor policies that have been created for decades that you can't just wash away. There's liquidity, there's overstimulus, there is poor lending. That is a big overhang, and that's why we still think that, even though, again, they'll print some sort of growth just because of where they are, where things are in general, but it's not going to be to what the market expects. And I think that is the overarching piece. And I think there's less and less focus on growth in China and a bit more focus on control, and that's going to, again, impede improvement on lending, on new financing, and then you layer in the problems with BRI, the problems with infrastructure and stimulus, and that's where there's only so many plates you can keep spinning in the air before one crashes and then they all come down. And I think that's what we're watching right now of which is going to be the next plate to fall. So when you look at industrial production growth picked up to 2.4% year on year in Jan-Feb, period from 1.3% in December. This was below the consensus of 2.6, and Bloomberg had projected 4.5%. So again, the industrial growth again missed. Retail sales strengthened, rising 3.5% from a year earlier in the 2-month period after a 1.8% decline, in line consensus. But again, Bloomberg expected 4%. And that's the thing. It's 3.5% is good. I'm not saying that retail sales of an increase of 3.5% is bad. I'm not. I'm saying that a lot of people expected 4% or higher. And that is, I think, what the expectation is. And people have to start re-rating things a bit lower. Fixed asset investment rose 5.5% in the first 2 months. This was higher than the expected of 4.5%, which again, there was some of that backlog, which is a positive. Service sector output came in at 5.5% after a 0.8% drop, but a lower base of comparison was a large factor, so it's not necessarily a convincing move. So again, it's a bit muted. Based on the activity indicators, the economy tracked a 4.1% growth in the first 2 months, putting it on pace so far to undershoot Bloomberg's expectations of 4.5%. And this isn't to pick on Bloomberg at all, because I think, especially on the Chinese side, they do a fantastic job of coming up with estimates in a very, let's just say, difficult place to find data. It's just people are going to have to adjust their expectations, and I think that's going to take time to move through the system. China's NBS monthly consumer confidence bounced, but you're seeing it's bouncing off into a weaker spot. So this is for January 23. You had people who are moving about, things are more open, people have freedoms, and again, not a lot of confidence. And that is the concern that I have, because we knew the industrial was going to be weaker because everybody was assuming all these great things. It's like, well, the industrial side never slowed to the same degree as the consumers did during zero COVID. So you're really saying that all of this exponential growth is going to be on the back of the consumer. And we've been saying that's not likely. And this is just another data point showing that we are closer to correct than wrong, given that going back to 2000, we're still at one of the lowest levels ever for Chinese consumer confidence. So now shifting to India, industrial production came in slightly better at 5.2%. CPI came in above expectations, coming in at 6.44 versus 6.4. Wholesale prices coming down a bit, expected at 4%, came in at 3.85. Exports came in at negative 8.8%, with imports coming in at negative 8.2%. And that, again, is a problem because it just shows that there's some industrial production out there. But when and we talked about it on the EIA show, I think it was 2 weeks ago, where so far sales have been slowing considerably on the refined product side. So again, one of the things that we were a bit early on was the slowdown in India. And that's something that we see picking up pace. Now, the CPI normalizing a bit is going to provide the RBI a bit of an opportunity to maybe wait. I think they do one more raise to try to force those rates and inflation below their 6% target, because they have a range of 2 to 6, because I don't think they want to give the market an option to let it do it naturally, because we've seen what that looks like. And I think that's going to be a bit of a surprise as exports and imports slow. Now, when we look at South Korea, PPI came in at 4.8%, but then when you look at imports, exports fell to negative 17.4, with imports falling negative 5.7. So again, imports are a leading indicator for not only exports, but also local consumption, which continues to be a bit weaker. While retail sales and sales in general improved, consumer confidence also improved. So you're getting a bit of a bounce in South Korea, but they've been struggling. So again, seeing that bounce makes sense. The question is, as we progress through the year and prices continue to move higher, when inflation remains a bit elevated, is that something that's going to wane? Japan, department store sales improved. National CPI expected at 3.3%, came in at 3.3. X food 3.1, X food and energy 3.5. So again, you're still seeing that inflationary base, and there's a chart that we're going to show in a moment of what the Taylor rule says things should be. Foreign bonds, again, things are buying in general continue to be sluggish. PMI composite came in at 51.9. Manufacturing 48.6, better than previous, but still in contraction. With services getting much better, a bit better from 54 in February to 54.2. But again, the question is going to be: does that maintain, or does manufacturing, because it's a big exporting nation, does the manufacturing weigh on some of those external factors? Leading index came in at 96.6, so fairly in line. So the question is going to be now, where are they in the cycle, and can they avoid raising rates? And the Taylor rule suggests the policy rates in Japan should be positive and should actually be something closer to the Taylor rule for 3.4% inflation, but with a 0% output gap is 0.8 to 1.3%, something that they have not yet achieved, which is why I still think rates are going to go up and Japan is going to be in a bit more trouble, because if they don't, and if they hesitate, I think inflation is going to continue to move higher, and real wages have gotten absolutely destroyed in China, in Japan, which is going to make spending difficult. And you're seeing it here. More evidence of today in Japan's service PPI, the commodity component as well is down, but the overall rate of increase still ticked up, which just means inflation is broadening. And as inflation broadens, it's going to become stickier and harder to get rid of, which is why the BOJ is going to be built in and it's going to have to raise rates. And if they don't, inflation is going to get worse. So that's what we have for you on Asia. If you have any questions, please let us know. We'd love to hear from you, anything you'd like us to cover. And, we hope you enjoy the rest of your Thursday. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.